Cracking the code, understanding credit. We hear it all the time. You need good credit. But why is it so important? Good credit can open doors to numerous financial opportunities, from securing loans to getting better interest rates on credit cards. But what does that even mean? For many, the concept of credit can be confusing and overwhelming. It's not just about having a credit card or a loan, it's about how you manage your financial responsibilities. It can feel like a secret code, but understanding your credit is crucial for financial success. Think of it as a puzzle where each piece represents a different aspect of your financial behavior. At the heart of it all are two key players, your FICO score and your credit score. These scores are essential tools that lenders use to evaluate your creditworthiness. While often used interchangeably, these terms actually have distinct meanings. Your FICO score is a specific type of credit score created by the Fair Isaac Corporation, while your credit score can be generated by various other models. Both offer a snapshot of your financial health, but knowing the difference can be a game changer. Understanding these scores can help you make informed decisions about your financial future. Think of it like this. Your credit score is like your overall financial reputation, while your FICO score is a specific, widely recognized evaluation within that. It's like comparing your general reputation to a specific review from a trusted source. Just like your reputation is built on your actions, your credit scores are determined by your financial behavior. Paying bills on time, keeping your credit card balances low, and not applying for too much credit at once are all positive actions. Late payments, high credit card balances, and even applying for too much credit can all leave a mark. These negative actions can lower your scores and make it harder to get credit in the future. Understanding your credit scores is about more than just numbers. It's about understanding how lenders see you. Lenders use these scores to assess the risk of lending you money. A good score can unlock lower interest rates, better loan terms, and even access to better housing options. It can make a significant difference in your financial life. On the flip side, a low score can lead to higher costs and limited financial opportunities. It can mean higher interest rates, less favorable loan terms, and even difficulty in renting an apartment. Let's dive deeper into the world of FICO scores and credit scores to demystify the differences and empower you to take control of your financial well-being. By understanding these scores, you can take steps to improve them and secure a better financial future. Unmasking FICO, the gold standard. When it comes to credit scores, FICO is a name you'll hear often. It's the benchmark that most lenders use to evaluate your financial health. Short for Fair Isaac Corporation, FICO is a company that developed the first credit scoring system. Founded in 1956, it revolutionized the way creditworthiness is assessed. This system, known as the FICO score, quickly became the industry standard and remains the most widely used credit score today. Over the decades, it has evolved to incorporate more data and provide a more accurate picture of a person's financial behavior. Lenders rely on FICO scores to assess your creditworthiness. Whether you're applying for a mortgage, a car loan, or a credit card, your FICO score plays a crucial role in the decision-making process. It helps them determine the likelihood of you repaying a loan or credit card debt on time. A good FICO score can open doors to better interest rates and loan terms, while a poor score can limit your financial opportunities. A higher FICO score signals to lenders that you are a lower-risk borrower, making you eligible for more favorable terms. This can mean lower interest rates, higher credit limits, and more negotiating power. Think of it as a report card for your finances, with your FICO score being the GPA that lenders pay close attention to. Just like in school, maintaining a high score requires consistent, responsible behavior over time. Beyond FICO, exploring other credit scores. While FICO might be the most recognized name in the credit scoring world, it's not the only player in the game. FICO scores have been around for decades and are widely used by lenders to assess creditworthiness. However, the landscape of credit scoring is much broader and more diverse than just FICO. Several other companies, including VantageScore and Equifax, have developed their own credit scoring models. These models are designed to provide alternative ways to evaluate a person's credit risk. VantageScore, for instance, was created by the three major credit bureaus, Experian, TransUnion, and Equifax, as a competitor to FICO. Equifax, on the other hand, offers its own proprietary scoring model that is used by various financial institutions. These models often use different algorithms and data points to calculate your score. For example, VantageScore might consider factors like your payment history, age of credit accounts, and types of credit in use. but it may weigh these factors differently than FICO does. These alternative credit scores often serve specific purposes. They can be tailored to meet the needs of different types of lenders and borrowers. For example, some lenders use VantageScore for auto loans, as it may provide a more comprehensive view of a borrower's creditworthiness in that context. Meanwhile, others utilize Equifax scores for credit card applications, finding that it aligns better with their risk assessment criteria for revolving credit. The specific score used can vary depending on the lender and the type of credit you're seeking. This variability can sometimes be confusing for consumers who are trying to understand their credit standing. This is why it's important to be aware of the different types of credit scores and understand which one a lender might use in a particular situation. Being informed can help you better navigate the financial landscape and make more strategic decisions when it comes to borrowing. Calculation conundrums: FICO versus the rest. One of the key differences between FICO and other credit scores lies in how they are calculated. While the exact formulas are closely guarded secrets, we do know the general factors that influence each score. FICO scores place a significant emphasis on your payment history, accounting for about 35% of your score. Other factors, such as the amount of debt you owe, the length of your credit history, and your credit mix, which is the different types of credit you use, also play a role. Other credit scoring models might weigh these factors differently or include additional data points in their calculations. The score range spectrum: decoding the numbers. Another notable difference between FICO and other credit scores is their scoring ranges. FICO scores typically range from 300 to 850, with a higher score indicating better creditworthiness. Other scoring models might use different ranges, such as VantageScore's range of 300 to 850. Understanding these ranges is crucial for interpreting your scores. A score of 700 might be considered good in one scoring model, but only fair in another. It's essential to know which scoring model a lender is using and what their specific criteria are for different credit tiers. Real-world repercussions: how scores impact your life. The impact of your FICO score and other credit scores extends far beyond just getting approved for loans or credit cards. These scores can influence various aspects of your financial life, from the interest rates you qualify for to your insurance premiums. Let's say you're applying for a mortgage. A high FICO score could mean the difference between securing a low-interest loan and paying thousands of dollars more in interest over the life of the loan. Similarly, a good credit score can help you qualify for lower insurance premiums, saving you money on your monthly bills. The importance of knowing your numbers. In the complex world of credit, knowledge is power. Understanding the difference between your FICO score and other credit scores is essential for making informed financial decisions. By regularly checking your credit reports and scores from all three major credit bureaus, Equifax, Experian, and TransUnion, you can stay informed about your credit standing. Remember, your credit scores are not static numbers. They fluctuate based on your financial behavior, so it's important to monitor them regularly and take steps to improve them over time. Taking charge: empowering your financial future. Navigating the world of FICO scores and credit scores might seem daunting, but it's an essential step towards financial empowerment. By understanding the nuances of these scores, you can make informed decisions that positively impact your financial well-being. Remember to practice responsible credit habits, such as paying bills on time, keeping credit card balances low, and limiting new credit applications. By taking proactive steps to manage your credit, you can pave the way for a brighter financial future.